This video will attempt to provide several reasons why a borrower might want to sign up for a variable rate mortgage instead of a fixed rate mortgage. Please stay tuned because later on in this video, after I explain this position, I will share a great tip on how to get the lower variable rate without having to put up with fluctuating monthly payments. Your mortgage rep will not be too happy with you when you bring it up. I'll also provide a bonus tip about how to avoid a penalty fee that many lenders will try to sneak into your contract, so stay tuned. Before I begin, I would like to clarify a few definitions. An open mortgage is when there is no maximum limit on monthly payments. A closed mortgage is where there are maximum limits on monthly payments. This is most common. A variable rate is when the interest rate moves with the country's prime rate. A fixed rate is when the interest rate stays the same until the next renewal. This video focuses exclusively on fixed versus variable. Please note that the variable rate mortgages are often referred to as adjustable rate mortgages or ARMs. Most people choose fixed rate mortgages because the banks succeed in convincing most borrowers that they should be fearful of the federal prime interest rates movements. This fear is not always justified. Here are some facts that the banks hope you will not consider. In most cases, increases in the federal prime interest rate are rare, minimal, and well publicized in advance. The bank takes on some risk by offering to fix your rate until you renew. The fixed rate is therefore set so high that the bank will be covered if there is an unpredictable rise in the federal prime interest rate. Many banks still sell your fixed rate arrangement to a third-party global fund, such as a bond fund or a mortgage-backed security fund. By selling your fixed payment contract, the bank is able to reduce some of their exposure to the risks of a federal interest rate fluctuation. The bank usually profits more on fixed rate mortgages because they charge such a hefty premium rate on the fixed rate option. The mortgage rep's job is to get you to pay as much interest as possible. You will probably notice that your mortgage specialist will attempt to encourage you to select the fixed rate option every time. They will usually say something like, "You only pay 1% more and you won't have to worry about rising payments." First of all, you should definitely take a step back and think it over whenever a salesperson tries to scare you into signing up for anything. And secondly, if you do the math, 1% is very significant for your mortgage balance. Even 0.5% is very expensive because most mortgage balances are hundreds of thousands of dollars. In order to downplay the higher cost of fixing your mortgage, the latest trend is for banks to push the borrower to renew with a term that is shorter than 5 years, sometimes as low as 2 years. In this arrangement, they can offer a slightly lower fixed rate because there is less probability that rates will rise a lot within 4 years versus 5 years. In order to clearly compare apples to apples, it is important to compare the 5-year fixed rate with the 5-year variable rate. A 3 or 4 year renewal term is a different product with different risk. Another common trick your mortgage rep will likely use in order to downplay the higher cost of fixing your mortgage is to confuse you by comparing the rate they're offering with the bank's prime rate. For example, they might say, "I can sign you up for prime minus 40 basis points, so it's a discount." The bank's prime rate is not the same as a federal prime rate. From the borrower's perspective, bank prime is meaningless, much like the pre-sale price of a pair of jeans. The words discount and prime minus are just sales tactics. The only rate that matters is the actual rate that you pay. In my opinion, the only way a fixed mortgage is better for the borrower is if the borrower knows a massive secret about impending excessive national inflation, and none of the banks know about it. So, aside from the Zimbabwean hyperinflation or something similar to the unprecedented baby boomer fueled inflation in the 1980s, the borrower pays more overall interest almost every time by signing up for a fixed rate mortgage. At this point, to be fair, I'd like to offer a necessary disclaimer. I will interject here to admit that there is indeed a risk that all variable rate borrowers must face. From the time you sign until the time you renew, which is 5 years for most people, anything can happen in this crazy world. There is a possibility that your rate will go up more than 1% within the 5-year term. If that happens in the 5th year, you still might end up paying less overall interest, but rates could go up much higher unexpectedly quickly. This would be a huge shock to all borrowers around the world, from homeowners to governments to banks. As they say on Wall Street, you need to take a risk in order to get your reward. Or in other words, either you eat good or you sleep good. All I can say about this scenario is that both fixed and variable borrowers would have to face those higher rates when they renew in any case, so the fixed rate can only protect you for a few years until you renew. And now I'll return to my preference for the variable rate option. Here's a fun trick. Tell your mortgage sales representative that you believe the federal prime interest rate will not likely rise higher than the bank's fixed rate within the next 5-year renewal term. The sales rep will probably become visibly irate and/or disappointed, almost taking it personally, as though they earn a higher commission on the upsell to the fixed option. In fact, you might need to explain this to the rep in order to get them to stop trying to aggressively sell you the fixed rate option. Right now you may be thinking, I have enough stress and I really cannot handle any future increases to my monthly mortgage payments. I could not possibly agree more. Early in this video, I promised to share a great tip on how to get the lower variable rate without having to put up with fluctuating monthly payments. And so, without further ado, here it is. If you opt for the variable rate, most banks still offer the option to fix your monthly mortgage payment amount. Yes, you heard me correctly. Mortgage contracts are more flexible than most people think. Very few people know about this, but it is not even a secret. Why didn't your mortgage rep tell you this? Because you didn't ask. All you have to do is ask for it. This option means that if the federal prime interest rate increases by 0.25%, for example, you will get hit a little bit because in the background, slightly less of your payment will go towards paying down your principal. However, in return for taking on that risk, you will get to have your mortgage set up with a much lower variable interest rate, and you will not have to worry about your monthly payment going up. Remember, the fear of rising monthly payment is half of the reason why most people are scared into the expensive fixed rate option to begin with. And just to clarify the benefits of a variable rate even further, if the federal prime interest rate drops, your rate will drop too, meaning more of your monthly payment will go towards paying down your mortgage balance. If the federal prime interest rate stays the same, you still win because you are avoiding the higher fixed rate. So before you go into the mortgage rep's office and negotiate the terms of your very expensive mortgage contract, shop around with at least 10 lenders, and as part of your research, remember to ask, can this bank sign me up for the variable rate option but with a fixed monthly payment? More likely than not, they will agree to it before you even visit them in person, because even though you're not going to let them upsell you into the fixed rate option, they know that they can still earn a commission. Otherwise, they know that there are competing banks out there who will gladly offer you those terms in order to win you over as their new customer. I have one more bonus tip for you that I mentioned at the beginning of this video before I wrap up. There's a rather dubious penalty fee that many lenders will sneak into your contract, mentioning it to you only in the last minute when it's time to sign. It's worth the effort to try to negotiate this trap-like clause out of your contract if possible. It's basically a fee of whatever amount they want, often a few $100s, that you must pay if you diligently shop around and switch to another lender at the time of your renewal. I recommend asking about this on the phone or by email before meeting the mortgage rep in person. They often say that it is non-negotiable, so the only way to avoid it is to avoid meeting with the banks that charge this fee. It might be in a section of the contract called Other Charges or elsewhere. If you leave this in, then in a few years the bank will charge you this stupid fee of a couple $100s in an attempt to prevent you from leaving your bank for a lender who offers a better rate. Please note that there may also be a government fee for assigning your mortgage to another lender upon renewal as well, which may be unavoidable. In any case, not all the banks charge this fee, so it's worth asking in advance. Please note that the purpose of this video is only to alert mortgage borrowers to ask and negotiate about options that few people are aware of. The viewer is advised to perform further research to decide on the relevance of the clauses in the mortgage contract. Due to the sensitive nature and high level of risk involved in real estate investments, please consult a licensed financial advisor and local real estate professional for more guidance that is specific to your situation.